Forex Focus brought to you by IG, and so much to talk about in today's market. Not only crazy price action we're seeing across US dollar Forex pairs, but getting ready for non-farm payrolls and the employment data that could really make or break this US dollar. Very interesting levels in all US dollar pairs. And with that, we thought, who better to bring on to talk about employment data, what it means for the US dollar, where the US dollar currently presides over these other currencies, than our friend here at IG, Paul Capetta. Paul, my friend, how are you doing?
Good. How are you, Frank?
Very good. Very excited about this Friday number that's coming out. You know, we always joke about Fridays can be really hit or miss, especially if there's not a data point. You and me and a bunch of the other people over at IG will joke about it can become losers club if there's not a lot going on. There was a lot going on Monday through Thursday, data points, news, and everything else. And on Fridays, you can feel like you're chasing something. But when it is a non-farm Friday, there's usually plenty to get done.
Yeah, non-farm starts at 7:30 Central Time, so 8:30 Eastern. You know, could be a lot of movement, could be a not. I mean, these for the last year, the NFP numbers have been pretty much more than last year. It's been quite some time now. It's probably since COVID. These NFP numbers really haven't been doing much because the job market's been so strong. But the jobs numbers that we've got this week have been all over the place. I think I was telling you on the way over here, I'm a little confused on what we're going to get tomorrow. Usually I have a good sense of what we're going to get, but tomorrow could be interesting. We'll say that.
Yeah, and that's while that might not be great for Paul, of course, everybody wants to know what the heck is coming down the pipe. It's great for traders in general. We want almost more unknowns. That creates more price action, more stuff to go down potentially in the market. And yeah, our expectation for tomorrow is 170,000 jobs, which is actually the same expectation as last month. It came in a little hotter than expected. But to your point, Paul, last month it came in a little hotter than expected. The jobs data of the week prior to non-farm, there's always a couple of lower level jobs data numbers that come out before the week of non-farm. And they came out all a little hotter than expected. And so we kind of knew what was coming. So when it came out 187 versus 170, the market kind of shrugged it off. It's like we knew where this was going. And that's what we seemed poised to get this week. We had that JOLTS number come out way hotter than expected. And then, interest rates skyrocketed, US dollar skyrocketed, and stocks moved lower. And it really felt like, okay, that number jumped the non-farms number here, and now everybody just knows it's going to be over. We saw some other economic data that came in actually under, which kind of levels the playing field here for that 170 number. Again, it just brings it back home to like, if we get a 200K number, then markets might do this. And if we get a 150K number, then markets might do that. We're kind of back at that indecisive, what will we get, and it will be meaningful for markets. And maybe you can decipher a little bit the theory or the historical price action, what we've seen the last couple of years relative to these job data numbers.
Yeah, so with FX, it's all loosely based on interest rate differentials. So, and inflation affects interest rates. So if job growth is strong, typically inflation is going to be higher. But more people have jobs, which means they have more money in their pocket, so they demand more goods. They can buy more stuff, in layman's terms. So when you see high job growth, everybody's employed, inflation is going to naturally tick up. Now we've been dealing with the inflation problem. They've got it a bit under control, but we're still definitely not out of the woods yet. And you'll hear Fed speakers talk, and if you look at history, it does take a long time to get inflation under control. So now we're looking at the job market because of how many rate hikes the Fed has done to see if that actually plays through, because it, technically speaking, should slow down the labor market, but it hasn't yet to this point. So when you see job growth, you naturally see higher inflation, which leads to higher rates, which means the dollar is going to be stronger. Flip side, if you start to see job declines, it's going to start to slow inflation. Now, when I start to look at this and I chat around with the desk all this week, is that if the job number were to come in very light, that would kind of change things quite a bit.
Yeah.
That's no longer just saying inflation slowing. That's more signaling a recession. But obviously, no one's predicting that, or we don't know where the jobs number, it could come on either side. But that's kind of what will play through. Obviously, if inflation slows, we're going to end up with a USD depreciation there, just because interest rates are going to impact some of their gains.
But to your point, we are at, and this is what kind of excites me as someone who's constantly watching these markets, who wants to see new stuff, big moves, and everything else. It feels like markets right now are more sensitive to these type of data points than ever, because even throughout the inflationary fear of the last 2 years, Paul, it's been relatively one-sided. We get a hotter than expected data point and markets do this. But it does very much feel like there's a two-sidedness to these markets once again, which is if this number comes in better than expected, then, as you just pointed, X, Y, and Z, but also if it comes in lower than expected, and that's very much on the table, then you might see not only like a sigh of relief, like, oh, U.S. dollars, the rally kind of cools off, interest rates cool off a little bit, but you might see them give back considerable ground. And we saw here earlier this week some crazy price action around JOLTS, which is a middle tier job number. We're going into the biggest job number of the month. And maybe you can tell us, maybe not so much, we can, of course, speak volumes about Bank of Japan intervention and everything else, but highlight to us what happened, because this is right at 10 a.m. Eastern when this number came out. And we're looking at the dollar-yen minute chart, something that you and I don't necessarily look at, but I had to go this, small with the time frame to really highlight what happened. 15 minutes wasn't going to do it. But why did we see such great volatility here in this dollar-yen market? Partially because the jobs data, but also because the level, right?
Yes. Yeah. So the jobs number, the JOLTS number came in. JOLTS is job openings. It came in hotter than expected, meaning there's plenty of openings. If people want a job, they can pretty much get it, is what that's telling us. It came in hotter than expected, rallied the dollar. Dollar-yen just briefly went above 150. And then it sold off, I think that looks like 250, a little over 250 points. I mean, that's in a matter of 5 to 10 minutes. It's a very aggressive move. If you were watching it, I was even watching the chart at the time. I looked up and dollar-yen was at 148. And then when I looked before, it was at 150. So I was like, all right, what just happened?
Is there a glitch? What is going on?
Yeah.
And there's no glitch.
Yeah, there's no glitch. That was the price. We didn't get an official report that the Bank of Japan intervened. I have to imagine they did. Something about the 150 level seems to be their psychological
It's been
line
one
in the sand.
day last year above 150.
Yeah.
One day.
So there's something there. It could be the Bank of Japan. It could be not be. It could be some market participant. But there is some psychological level in the market that if it gets to 150, it's going to pull back. It doesn't mean that's like a law.
Yeah.
Like it could blast through 150 if the jobs number.
The next time it could be 150 and a bunch of orders come in to move beyond it. It can be anything. And of course we could talk about intervention or whatever, but to me more than anything, it's just one, these data points are so relevant right now as we try to feel out, are we in inflation or are we on the precipice of recession? But two, Paul, like I say, it feels like forex markets are just extremely sensitive right now, and for good reason. They're so close to the extremes. Like you highlighted, that high, and this is the high or low for whatever market for the last year for dollar-yen was 150.36. It closed there one day last year and then backed off of it. And we're within a couple hundred pips of that. You look at Aussie, we're within 200 pips of the low for Australian dollar. This kind of crept up on me a little bit, and that should be dollar CAD, not CAD dollar. But the Canadian dollar also close to its lows, or dollar CAD very close to its highs for the last year at 138.80, and we're within 150 pips of that, given the downside we've seen in crude oil. But very close to these extremes and making these markets especially sensitive because there can be a lot of orders stacked up around those prices, right?
Yeah, exactly. I mean, you talk about, just the move in the 10-year has really elevated the dollar over the last really 2 weeks. You've seen kind of the exasperation of those moves. They've given some of it back today. It was a bit of a run against the dollar today, so dollar kind of weakened across the board. If you look into that before the non-farms, it's tough to know what's going on there. Are people just covering their longs, or is there something else afoot? But it's been an interesting time. The dollar's strengthened a lot, and it's really on the back of yields. That's the main thing there.
Yeah, absolutely. Definitely the highs in U.S. yields correlating to these highs in dollars. And like I say, making markets, forex, equities, everybody kind of iffy around this non-farm number and future inflationary numbers. And yeah, I just wanted to highlight quite quickly this Aussie piece, just because it is one of the closest to its last year's price extreme, and traded down to 63 even very briefly, and 62, 63 has been the low for this market for the last year. In the pandemic, there was that March, April period where it punched down below 60 cents and came back. Definitely a particularly volatile one, Paul, and one that people have a lot of opinions about. And this kind of goes across most of the major pairs. Traders are taking the contrarian view going into this number, which is on the short side of this strong dollar, as you see 80% of IG clients with Aussie positions long Aussie short dollar.
Yeah. I mean, they're maybe looking for the dollar gains to take a break. Doesn't mean it has to. It can. It's interesting that they've kind of converted to going against the dollar. U.S. traders typically like to be long dollar for whatever reason. I don't know if it's a psychological thing, but that's historically what we've seen. But it's a change, It's something different. They're taking a different approach to it. You can use this data how you will. Sometimes I use it as contrarian data. Sometimes I'll follow it. But it's interesting to see that they've decided to move away from the dollar after kind of the last 2 years of what they've done, basically.
Great point that it's not necessary. It doesn't have to be all short dollar positions. It could be a lot of people who've been long dollar have now said, this has been enough of a dollar run. We're, taking our profits here. Either way, extreme prices for these different forex pairs and extreme sentiment around them will make for a really interesting non-farm payrolls tomorrow.